Hi, welcome back to part 3 of step 5 of the accounting cycle, which is adjusted entries. Now, last time or last video, we left off on some prepaid expenses, those being supplies and insurance. There is another prepaid expense, and this one is this might be a little bit confusing to some people, okay? But for most, hopefully, it's simple enough, okay? Another prepaid expense is, well, like I told you, assets are pretty much all prepaid expenses with the exception of cash and accounts receivable, okay? Now, we have some prepaid expenses like supplies and insurance and rent and all that stuff. Those are prepaid expenses, but they're kind of still short term, okay? Maybe 6 months up to a year, okay? As far as your prepayment is going to be, okay? Now, there are other prepaid expenses that are more than a year that last for a long time, such as buildings, equipment, and motor vehicles. Buildings can last for 30 years, depending on maintenance and stuff like that, and depending on what you add to them. Equipment, things like machinery, trucks, cash registers, those can last for a long time, right? And motor vehicles, those can also last for a long time. There are some people still driving their inefficient, as far as fuel cars from 1998 or some shit like that. Anyways, those are going to last for a long time, okay? So what happens is you still have to allocate the cost of those prepaid expenses, just like we did for insurance and supplies, okay? Now, the adjusted entries for insurance and supplies, as you notice, we affected the account itself, like the supplies account, that's an asset. We affected that account itself when we did the adjusted entry by crediting it. For prepaid insurance, we did the same thing by crediting it. For these types of assets, buildings, equipments, and motor vehicles, we require that they be listed at historical cost on the balance sheet. So, historical cost is what you paid for them originally. So, if you bought the building for and paid for it $80,000 or something like that, then it should be stated on your balance sheet under $80,000, okay? Forever. Okay, forever until you get rid of that building or you get rid of that equipment or the motor vehicle or whatever. But it should be listed on there at historical cost. Now, you will still allocate a portion of the cost of that asset to the period in which it generated revenues for you by a depreciation, something called depreciation. Depreciation is just a decline in value, okay? For accounting purposes, it is allocating the cost of an asset to an expense, okay? To expense over its useful life, okay? That's what it is in accounting. What that means is, let's say you bought a piece of equipment. Let's say it's or a motor vehicle. Let's say it's a truck, right? And the truck, you bought it for 15,000, okay? And you estimate that this truck is gonna last you for at least 5 years, okay? What you can do is say that, the bumper of this truck was used, or well, 1/3 of this truck was used to generate this much of revenues for the first year, or 1/2 of this truck was used to generate this much revenue for the second year, or 1/5 of this truck was, you get the point, right? You can't do it that way, okay? So you have to assign a cost to this asset, and then use depreciation to allocate a portion of that asset, a portion of the cost of that asset to periods in which it generated revenues. Okay, so let's say it's 15,000, right? What you can do is through depreciation say that, well, 3,000 of this asset was used in the first year, or 5,000 of this asset was used in the second year, or 8,000 of this asset was used in the fourth year, and so forth, something like that. Okay, so you can allocate the cost of the asset over its useful life for that 5-year period. Now, depreciation doesn't work like I just explained, 3,000, 5,000, 8,000 with these like random numbers. There are depreciation methods that you have to follow for financial accounting purposes, like straight line depreciation, double declining, half declining, sum of digits, all these depreciation methods that we'll get into in later videos. Okay. And here's one important thing: depreciation does not attempt to report the actual change in the value of the asset. Again, it's just allocating the cost of that asset. So it's not going to depreciation does not explain a drop in value of an asset. So let's say you add the asset, um, you bought it for 80,000, okay? And let's say the fair market value of the asset now is I don't know, 60,000 or something like that. Depreciation does not do that, okay? It's just allocating the cost of an asset to expense over its useful life, okay? I know the real definition of depreciation is a decline in value, just like anything declines in value, but for accounting purposes, all it is just the allocation of the cost of the asset to expense over its useful life. Okay, that's all depreciation is. Okay, again, does not attempt to report the actual change in the value of the asset. Okay, the actual change. Okay. So let's take a look at depreciation. What I want you to worry about for now is the adjusted entry. The adjusted entry for depreciation is real simple. You debit depreciation expense, again, allocating the cost of the asset to an expense, or allocating the asset to an expense, right? Depreciation expense. And then we have this account. So instead of touching the asset account directly, we have an account called accumulative depreciation. Accumulative depreciation is a contra asset account, okay? So whereas assets increase on the debit side, accumulative depreciation increases on the credit side. And then accumulative depreciation on the balance sheet, as you will see, will come out of the respective asset that you are depreciating, okay? Because remember, these long-term assets, known as property, plant, and equipment, or PPE, are listed at historical cost. We want to see them at historical cost, okay? So we, on a roundabout way, go through this account called accumulative depreciation. So here we have an example. For Pioneer Advertising, assume that depreciation on the equipment is $480 a year, or $40 per month. So normally you just do it yearly instead of per month, on a month-to-month basis. So, but the journal entry is still the same. It doesn't matter, okay? So we can do the 40 per month. Again, you're still going with these artificial time periods. So in this case, it begins at the beginning of the period, October 1st, and then ends on October 31st. So um, this asset depreciates at a rate, or a value, of $480 per year. 480 divided by 12 is 40 per month. So it depreciates at $40 per month. Okay, we're allocating $40 per month the cost of this asset, and then we're transferring it to this expense account. So depreciation expense 40, and then accumulative depreciation 40, and that's it. Okay. The analysis, you still have to do the same thing. Okay, still have to do the same thing. Basic analysis, the expense, depreciation expenses increase 40. The contra asset, again, if there was no, if we did not require these assets to be listed at historical cost, then we wouldn't use accumulative depreciation. But here we do have to, because these are long-term assets. So we use this contra asset account called accumulative depreciation. Okay, so accumulative depreciation, contra asset is increased by 40. In totality, the cumulative depreciation gets subtracted from the assets. Okay, but here you're increasing accumulative depreciation and you're also increasing expense, depreciation expense. Okay, totality, depreciation expense will get subtracted from stockholders' equity. Okay, debit credit analysis again. Depreciation expense increases on the debit side. That's why we debit it. Accumulated depreciation increases on the credit side, even though it's technically an asset, but it's a contra asset, so it goes the opposite way. So we credit that, and this is the journal entry uh, for $40 per month, 480 a year. Okay, and then you just post. You have equipment. We didn't touch on equipment, but this is the account that the accumulated depreciation is affecting. Equipment stays the same. Okay, we bought it for 5,000. It's going to be listed at 5,000 historical cost until we sell it or trade it or something like that. Okay, then we take it off the books. Here we have accumulated depreciation reflecting of the journal entry or the adjusting entry, the one adjusting entry, debit or sorry, credit of $40, and then the ending balance is $40. Again, these are T accounts, not the actual ledger, but this is posting. Okay, and then depreciation expense only for the adjusting entry. We didn't have it before, so we only see the date of October 31st. Debit of 40, and then the ending balance of 40, and that's all. Okay, how is cumulative depreciation reflected on the balance sheet? Well, this is how it's reflected. Okay, whatever asset you are depreciating, okay, you'll have accumulative depreciation for equipment, for buildings, um, whatever. Okay, for property, plant, and equipment. Okay. So it's a contra asset account. So in this case, it's a contra asset account of equipment. So it gets subtracted from equipment. And what you're left with after you subtract the accumulated depreciation is the book value of the equipment. Okay? The book value of the equipment. So the book value is just the historical cost less the accumulated depreciation, and that's your book value. That's your book value of this asset. Okay? And that's all. That is all. Okay. Depreciation, we'll get a little bit more into it in later chapters when we actually get into the fixed asset chapters. These are known as fixed assets, like buildings, equipment, machinery, and all that stuff, because they can last a long, long time. Okay, property, plant, and equipment, fixed assets, whatever you want to call them. Okay, but they're just long, long, long time, long-term assets. Okay, that's also another name for them. Okay, here we have some examples and why you need these adjusting entries, right? Why you need these adjusting entries. Insurance supplies, these are for prepaid expenses, advertising, rent, depreciation, the reason for the adjustment. Prepaid expenses, when you pay in advance for these expenses, they're assets, right? So what happens if you don't record that adjusting entry? If you don't record that adjusting entry, then your assets will be overstated, as it says here, and expenses will be understated. Okay? Remember, when you prepay for these expenses, they become assets. Okay? Because assets are technically, or really, prepaid expenses. So what you have to do as you use them, or consume them, you have to allocate, okay, the cost of that asset to an expense account, which is what it really is. Okay, insurance is an expense, supplies are expenses. Okay, but they become assets because you prepaid for them in advance. Okay, you still have not consumed them or used them yet. Okay, so if you don't do that adjusted entry, then assets will be overstated. You will have expenses on the balance sheet that listed as assets, okay, which is not representative of the actual story, what's actually happened, right? Because you used them. So now you have to transfer them to an expense. If you don't transfer them to an expense, then expenses will be understated. Make sense? Yes. Hooray. Okay. And you have the adjusting entry here, just like we did before. You're affecting an income statement account and a balance sheet account. Whether that be a contra account or whatever, does not matter. Okay? So, that's pretty much it for prepaid expenses. Let's see what's next on the docket. Unearned revenues. Remember, this is the other deferral, and deferrals, as you should remember, are postponements. In this case, we are postponing the provision of a service or the delivery of some merchandise that we sold, right? So here, somebody pays you in advance, somebody pays you, so you are the seller, somebody pays you in advance, but you have not performed the performance obligation yet. So you cannot recognize revenue. So here we have some examples. Rent, that's you on the other side. So remember, for prepaid expenses, that's you are the buyer. In this case, you are the seller. Airplane tickets, magazine subscriptions, customer deposits. Okay, a lot of examples of unearned revenues, right? A lot of examples. Okay, so let's see how it works. Again, um, two accounts are affected in this case. Okay, two accounts are affected. So let's take a look at an example. Pioneer Advertising Inc. received $1,200 on October 2nd from R. Knox for advertising services expected to be completed by December 31st. Unearned services revenue shows a balance of $1,200 in October 31st. Trial balance. Analysis reveals that the company performed $400 of services in October. Okay? So again, the rule stays true, okay, for adjusting entries. What you see below here is the adjusting entry. An income statement account is affected and a balance sheet account is affected. Okay, originally when we booked this 1200, we did cash debited for 1200 and we credited unearned service revenue for 1200. Okay, that was the credit. Unearned service revenue was the credit. Now we had it at 1200, so the trial balance was not up to date on October 31st. On October 31st, it is not up to date. Okay, so we're going months to months again. So what is that? October, November, December. That is 3 months. That's where they got the $400 from per month. Okay, so 1200 divided by 3 is 400. So we are earning $400 per month. So on October 31st, we have to transfer $400 from this unearned service revenue account, which is a liability account, okay, because now we earned it, so it's no longer a liability. We no longer owe the full 1200 to this individual if we never provide the service. Okay, now we have provided $400 of those services. Okay, $400 of those services. So now we eliminate $400 of that liability, unearned service revenue, and book it as actual revenue because now we have performed the performance obligation and we transfer it to the service revenue account. Cash is already over with. Okay, so we just have to eliminate the liability and transfer it into this revenue, which is what it originally should have been booked as, right? Because if we had delivered these advertising services originally, then it would just be a debit to cash and a credit to service revenue, okay, which is what you see down here. Okay, but since we did not do that, okay, keeping with accrual basis of accounting, cumbersome, right? We have to make this adjusting entry to make everything correct. And then we go through the basic analysis again. For adjusted entries, you still have to do this analysis, generalized and post. In this case, the liability, unearned service revenue is decreased 400. So this is starting from the adjusted entry. What I want you to do is think about the original entry, and that will make your life easier. The revenue, service revenue is increased 400. This is for that adjusted entry. So our equation analysis, liabilities are decreased by 400, but revenues are increased by 400. Stockholders' equity increases, liabilities decrease. It's a wash, and our accounting equation is still unbalanced. Great. Um, Debit credit analysis, again, liabilities decrease on the debit side. That's why we debited unearned service revenue. Originally, we had it credited on the original journal entry throughout the period. Um, Credits increase revenues. Credit service revenue $400. Simple. Yes, I love these PowerPoints, right? They make everything so simple. Okay. Then journal entry. This is just what we just saw. Unearned service revenue is debited 400. Service revenue is credited 400. Everybody's happy. That's that just an entry. And then we post to the ledger, or in this case, T accounts, T accounts, T accounts. Okay. Um, Adjusted entry 400 for unearned service revenue. Originally, we had the 1200. Okay, that's what we originally received from these customers for the advertising, but then we provided $400 of these services, so we no longer owe that. Unearned service revenue is a liability, and then our balance in that account, we still owe $800 worth of those services to these customers. Okay, service revenue. Originally we had 10,000, so I guess we earned that originally. Then here we add that just an entry for the stuff that we didn't earn. Should have been recorded as service revenue originally, but we didn't do it. So um, when we do it, then it becomes service revenue, transferring from a liability to a revenue account. Add the 400, and then our balance is 10,400 buckaroos, man, buckaroos. Here we have the same thing, explaining unearned revenues and the need for them. Some examples: rent, magazine subscriptions, customer deposits, for a future service, blah blah blah. The reason for adjustment, as it says in this beautiful PowerPoint. Unearned revenues recorded in liability accounts are now recognized as revenue for services performed. So again, originally you did not provide the full service, okay? You postponed the provision of this service to the client, so you cannot recognize it as a revenue. You have to recognize it as a liability. Open up a liability to say to yourself, remind yourself that I have not performed the performance obligation. So if I don't perform the performance obligation and I'm a decent piece of shit, that I will return this money to these customers. That's why it's booked as a liability originally. Okay? Now, the need for the adjustments. If we don't do the adjustments and you do provide the performance obligation, then liabilities will be overstated if we don't do that just an entry. And revenues will be overstated because you are underselling yourself now because you performed the performance obligation. So to do that just an entry, you have to transfer it from this liability account because now you are just a decent piece of shit who is providing the performance obligation at this point, and you earn those revenues. So you should do that just an entry to signify that to your investors or the people on the outside looking in. And that just an entry again affects a balance sheet account, and it affects an income statement account. In this case, we are transferring from a liability to a revenue account. Okay, so hopefully that makes sense, and I will see you guys in the next video, which will be step or part 4 of these adjusted entries. I think next time we'll look at accruals, and hopefully that will make sense. Goodbye.